Okay, let's go now dive into the accounting. Again, principles of accounting, first part, chapter 1. I'm going to talk general about the accounting and about the business environment, and we're going to do some exercise today. See how that goes. First, let's define what the accounting is, what are the users of accounting, what they want, and why do we need this accounting? I know probably some of you are super scared about accounting. Some of you are wondering, why do I need this accounting for? Surprisingly enough, most of you are already doing accounting. If you have a bank account, you already know that this account have a balance, and that balance coming from the money coming in and the money going out. And money coming in increasing the balance in my bank account, money going out decreasing the balance of my account. And once you see the bank balance going down, you start wondering, why my balance going down so fast? Where the money going? So you start accounting for your expenses. So if you already do that, you are in the accounting business. So what is the accounting? Accounting basically is a language which have a specific terminology. That's why we're going to make it a little bit scary for you, because we're going to put this terminology, which is, we're going to put the words that people don't usually understand, and they need more explanation. Why we're going to do that? So we can charge them more money. Now, bookkeeping is only one element of accounting. Bookkeeping is accounting. Let's say accounting is whole the library, which have the information of everything. So basically, imagine the library, we're putting all the information from where we're going to get that information for every transaction that happens in our life or in the life of the business. So everything that happened, we're recording it. We make a record and we put it somewhere in the library. And that library is going to store our information. So now we have this account information for every different events. Even if you go back to the old times when they're organizing the library, within every kingdom, let's say the king Carol I, for example, he was king from this time to this time. Now the question is, what's happened with this time? Well, the first thing, he made this. Second, he made that. He built that many bridges. He destroyed that many houses. He acquired that many lands. So what I'm doing now? Am I recording history about this king, or I'm doing accounting for that king? Basically, I'm recording the events that happened through that, the time of that king was. And during that time, then we're going to see what kind of activity happened. From the accounting point of view, we can see the things that he achieved, are they more than what he destroyed? If what he achieved is more than what he lost and destroyed, that means he was successful king. Same thing with here. The only thing is we're going to focus only on the money side. Right. So the big bookkeeping is what? The bookkeeping is basically recording every element, but keeping everything in this one place and extracting the information, preparing a report. That's what the accounting is. So we have to understand what old means and how to help to make a better decision. That's why we need the accounting. So once we have the older information presented in terms of the report, we can see what happened, when it happened, is it going to happen again or it's not going to happen again? What kind of decision we have to make based on what already happened? So again, the accounting information to that thing is some kind of historical information, for which historical information we can use to make a decision in the future. So again, accounting is information system that's going to measure the business activities mostly financial activities. So now on the financial reports, we're going to, even though in the warehouse you have 37 cars, 7 motorcycles, 15 SUVs, that's not what you're going to report on the financial report. You're going to report inventory, that much money. You're not going to put inventory, 37 vehicles, 15 SUVs, 17 motorcycles. You're not going to put that one. You're just going to put the financial information about the value of whatever assets you have in your inventory. We're going to process that information in terms of the report, and we're going to communicate that report with the people who are making decisions. And for that reason, that's called the business language of business. So the accounting is basically language of business. So financial reports. Why do we need the financial reports? Well, the financial reports obviously is going to help us to answer some questions. Which questions we're going to answer? There will be different questions. Depends what user of the financial reports looking for. They can give you fundamental, they can answer the fundamental question of the business. Is this business profitable? Imagine you're the investor. You have money, which you don't need right now, and you want to invest because you want more money. So you decide, okay, I'm going to invest in business. What do you need to know about that business? Is this business making money? If it's making money, how much money he is making? How is it profitable? How profitable is? Now, if you're inside the company, if you're actually buying the company, once you go inside the company, you can ask yourself, okay, so what's the capacity of the business? Can I expand the business? If I have to expand the business, do I have to hire more people? The other thing is that you can think of, okay, so now I have this business, but this business, if I don't improve the equipment, if I don't purchase a new equipment, that business eventually is going to die because of the technology changing so fast. So what should I do? Should I purchase new equipment, or should I shut down the business, open new business? What exactly should I do? If I end up, okay, let's purchase new equipment, the question is, can I afford it? That brings us to the users of the financial statements. Which are the users of the financial? So we have this accounting information, which recording the events, the dollar measure of every transaction, post it in the right account, preparing the financial reports for the users. Which are the users? Well, they can be decision makers, or they just need the information. For what for? Information for many purposes. Let's put it very general, many purposes. So which are the decision makers? Well, there are two types of decision makers. One type we already established, those are the investors. Now, you can put, how about the owner of the company? Well, why he opened the company in the first place? To make a profit. So if you make the profit, did he invest in the company? Well, yes, he did. So that make him investor. The fact that he's working in the company and calling himself an owner doesn't change the fact that he's actually the main investor in the company. So in the bigger category, that will be investors. And the next bigger category will be the creditors. Now let's see which one is care about what. Investor, what investor wants? Investor wants profit. He wants to make sure the business is profitable. Why? Because I invested my money and I expect return. What form, we're going to see a little bit later, but if I have to be going forward, that return will be in form of the dividend. How about the creditor? What the creditor wants from the business? Does he want business to be profitable? In a way, he does, but not necessarily, because the creditor cares only about two things. Is the company going to be able to pay my principal if I borrow the money? And second, what is my interest? Now, let's put it in the very interesting perspective now. Imagine I'm the person who wants to buy a house. Obviously, I don't have the money. I'm short with some amount. I'm going to the bank. What the bank's going to ask me? What's your income? Why the bank is so concerned about my income? Is it because they care about me? Am I have enough money to live? Or they care about, is he going to be able to pay my interest and my principal? Which one is it? Did the bank care about me or they care about their money? Which one is it? Most likely is the second one. Why? Because they're just a bank. But anyway, they're protected. Why? Because if I don't pay them the money, they're going to take my house. So do the bank care about am I profitable or not? Not really. So in that case, put it in the perspective of the creators. Did the creator worry or care about the business? Is it profitable or not? Not, don't need to. Why? Because he wants his interest and principal. End of the story. Are you making money and giving to your investors? I don't care. Pay me my interest. We're going to see later who gets the money first, the creditor or the investor. The other thing is there will be always managers in the company who have to make internal business decisions. Those will be the direct users of the financial statements, and there will be individuals, will be the persons who also have to make decisions. Now, for the information needs, we're going to need those non-for-profit organizations. So the non-for-profit organization may need some information about the business and rely on accounting information. Especially when you're running the non-for-profit organization, you want to make sure that the services that you're providing for the public, which are not for profit, actually meet the public. Government regulators, well, the government regulators, they always want to know more about the businesses, but not because, again, don't get me wrong, they want to know more about the individuals and they want to know more about businesses. If you been living in Canada more than a year, you already know that Canada Revenue wants you to tell them how much money you make last year. Why? Because they're caring about are you are you able to live in Canada? No. The only reason that they want that information is to make sure that you pay them enough. There's no reason for Canada government regulators or Canada Revenue to ask you, hey, how much money you making? Are you able to live in Canada? Are you able to pay your expenses? They don't care about that. The only reason that they need that information is to calculate how much taxes you owe them. That's all. Sad story, but that's the reality. So those are the people who waiting for our information, so they can make sure that the money that we're paying them are enough, or we're not paying them less. So now let's see which are the two elements of the accounting. Now we have two main branches of accounting. One is the financial accounting. The other one is the management accounting. What's the difference? Well, the financial accounting is the one that using again, in accounting, we having transactions. We're recording those transactions. We put them in the appropriate account, then which are organized by different categories. We're going to see a little bit later what's those categories. We're collecting the information there, and then we're presenting the report. Now, those reports, we have two main type of users. One is external users, which is outside of the company, and the other one are internal users. Which will be the external users? Those will be the creditors and investors. Which are internal users? Those will be the managers, the people who are actually involved in day-to-day operations. Now, because of that, they're gonna have a different perspective when they look at the same information. Let's see what is the perspective first. Financial accounting is prepared again for the external users. Some of the internal users, they may use it if the owner of the company is working in the company, but mostly because of the investors and creators. And those statutory users, which are Canada Revenue, some government organization, which are very concerned of the money that you're generating from your business so you can pay them enough. So what they're looking for, investors should invest in this company. Creditors, if I borrow the money, if I lend them the money, are they going to be able to pay my interest and my principal? Statutory, from where these people making money, and are they paying me enough of the taxes? Then we're going to the managerial accounting. This is the financial accounting. Then we're going to the managerial accounting, and the managerial accounting, again, the users are inside the company. That will be on the individual level, can be for the business users, for the managers. What their focus is? Their focus is which product is profitable, which client is profitable, which division is profitable. Should I continue with this product in the future, or should I cancel it? Should I keep going with this client, or should I eliminate the client? Should I keep going with this division, or should I eliminate it? Should I move to the new business area? What exactly should I do with the business? So you can see the managerial accounting motivation is something related to the future of the company, where the financial accounting is more likely supporting that future in terms of investors and creators. So now we have this managerial versus financial, and we're going to have the management accounting. This is the Hunter Environmental Consulting, and the Hunter lost the money on its first consulting project. So if the company losing money on the first consulting project, then the manager accounting information would be used to determine what's the cost, what was the profit, did we make a mistake on our estimation, and when we providing the proposal for the project, or where exactly we made a mistake, did we spend more hours, what exactly happened. On the financial side, if we have to do the financial, now that go on site, and the bank manager, when he see the report, is going to say, oh, you guys losing money. Do you still have the money that I lent you? Yeah, we keep it in our account. Oh, okay, then fine. Pay me my interest and make sure that you're keeping the money that I lend you. So because I need my interest and my principal. That's how the external user is looking for the information. That's how the manager is looking at the same information. We're talking about the same information. We're not changing the information. Now, who are the people who are preparing those reports and dealing with accounting? Those are people who have a professional accounting designation, or they belong to some professional accounting body. That's called, so right now in Canada, we have only one professional body, which is called Chartered Professional Accountants. There used to be 3 accounting bodies: Chartered Accountants, Certified General Accountants, Certified Management Accountants. But 10 years ago, in 2014, actually they started the merger in 2013, and slowly they get all the accounting bodies to that merger. Some of the accounting bodies didn't want to go to the merger, like a CGA, they didn't want to go to the merger because they were the only profitable of all those 3 accounting bodies. But CA paid those CGA executives ginormous amount of money, and they say, okay, fine. And yeah, if the thing is, sadly enough, but it's true. Do you know, if you cannot buy something with money, what you can do? You can buy it with a lot of money. So everything is for sale, people. Now, what's going to happen with this Canadian professional accounting designation, which is Chartered Professional Accounting. Now we're going to have accountants, and we're going to have obviously auditors. Auditors will be the one who's going to example of the work done designated with the accountants. So one of the work is the audit. Why do we need audit? Well, that's an interesting question, which CPA couldn't answer me that question. Even though I asked them so many times why we need auditors. Yeah, we need auditors. What they're going to do the examination of financial reports. They supposed to be independent accountants. And the auditor, they're going to express opinion whether or not financial statements actually fairly represent the actual situation in the company in the form of the reports. And auditing obviously is not perfect. In fact, if I have to be honest with you, sadly, but it's true, all the financial crises in the world that happened so far in the history of the humanity, especially the latest one, the Great Depression, when we go 1980, there was a crisis there, financial crisis during the Ronald Reagan. Then the next one was 2000 with the WorldCom and Ron. And the next one was the financial market crisis 2008, which shook the world from everywhere. The reason for those were not accountants. They were actually the auditors. So, why do we need those companies and the auditors might have they have to have those ethical standards and the relationship among the accounting businesses. So we're going to have these decision makers. We can have the public company that using the shares traded on the stock or exchange, and we're going to have independent accounting company, which is perform audit, compliance, and anything that's just to make sure that those guys, investors and creators, are presented with the correct information based on what happened in the company itself. Now, this one is not longer available, so I don't have to spend time on this one. They used to be available, but not anymore. So we can easily delete that one out of the Canadian profession. There's only one option for you if you want to be accountant, and that's a CPA. And that's not a bad option, if you ask me, because now newly graduated CPA, just passing the final CPA exam right now, and as soon as the employer find out that you passed the CPA exam and you are CPA, newly graduated CPA, $100,000 are available for you sitting on the table, waiting for you to sign the contract. That's the minimum that you can start right now. Before, that wasn't the case. At the time when I became a professional in 2009, you need at least 6-7 years until you get to $100,000. Now, at this, everything changes. There's literally a shortage for the accountants. Believe it or not, there's a shortage of accountants. Not many students now want to be accountants. Why? Because it's I won't say it's hard. On the level of hardness, it's kind of fair hard for the amount of money that you're gonna get later. And which one is harder, to become a doctor or accountant? Definitely to become a doctor. But if you become a doctor, then we're talking about different salaries there. With the accountant, for the amount of effort that you have to put and the amount of investment that you have to put in the CPA, you're getting a way good rate of return. So if you're wondering for your profession, don't wonder. Just jump in it. That's my comment on that one. And I'm going to stop here because we have to talk about the ethic in the accounting professions. Ethic always goes with the accountants. Every professional accountants, including me, we are governed by the standard professional conducts and then we can apply this conduct, either public, either private accountants. We are all bind that standards. Which are the rules? The common rules that we have to, all the information is confidential. So whatever we learn about the company is confidential. You're not sharing with anyone, regardless how much you want to. We have to maintain this professional reputation. We have to work with the integrity, due care, and competence. So that means we always have to improve ourselves, always have to think about the worst case scenario, and always have to think about the public. We have to refuse to be associated with any false or misleading information. We have to comply with the professional standards. So basically we need to know those standards, and we have to follow the standards, and we have to be independent, which is kind of tricky thing to do, to stay independent once you know too much about the business, when you become a controller of the company. But that's something that I can discuss with you when you become, when I see you in the high level courses in accounting. So accountants, we're going to hold those special positions which are in trust of the society. So basically, the interesting thing was, I don't know if that's still the case, but when I came here in Canada 22 years ago, it's going to be 22 years on May 25th. When I came in Canada, when I get my Canadian passport, on the application for Canadian passport, it says this, you need signature of 2 professionals, which consider to be professional. Professional is either doctor, either lawyer, either accountant. Only those 3 count for professionals. I don't know if that's still the case, but yes, I asked my family doctor to sign my application for Canadian passport, to become a Canadian citizen and for Canadian passport. And then I asked one of my colleagues, because we both, no, I wasn't CPA on that time. So yes, I asked one friend who was CPA on that time, and he signed my papers. So keep a good relationship with the professional, or you become a professional because you don't know what's going to happen. Circumstances or external pressure that can influence the accountant to present the information which is not presenting the truth in the company. There might be circumstances where the accountants are pressured by the other parties to put accounts or to do something which is misleading or can be unethical. But this bias is always pressured, and they're always going to be biased to make the things look better. So there's a lot of conducts, there's a lot of things that we have to have in mind in order to be professional. In business, what's the etiquette in business? We have to understand that confidentiality, and we can rely on the financial information to be used only to the financial making decisions. We have to break down the ethical behavior. For the external auditors, if you're external auditors, those we intend to provide users with the confidence that the information that they're reading on financial report is actually true. And new regulatory and reporting requirements, they have to improve usually to the quality of the financial reporting. For those reasons, we using those ethical, again, it's all to protect the public. Let's go with now with the compare of the business forms of the organization. What kind of business form of organization we have here in North America? We have 3 main business form. One is sole proprietorship, means that each of us can open his own company as we speak. Do you have to incorporate it? No, you don't. Let's say somebody asks you right now, you know about plumbing, and can you start plumbing business? Yes, you can. As a sole proprietorship, you can start the business right away. The next form of business is partnership and limited liability partnerships. And the last form is a corporation. Let's see which one is what and what's the interesting with that form. Let's go with the proprietorship, sole proprietorship. Sole proprietorship means that one owner. What's the life organization? As long as owner wants to continue with the business is going to go. Organization is going to go. If the owners decide to departure from life or get hit by a driver in Canada, well, business is over. Legal status. Well, the owner is the one who is the business. So there's no separate legal entity. There's no separation from the legal point of view between the business and the owner. Owner is the business. Business is the owner. End of the story. Who paid the taxes? If the owner is the business, owner pays the taxes on the individual level. So if you go, that's why I would suggest you, for those of you who are not accounting students, since you go to the accounting, the other interesting thing that I would strongly recommend you, get the sense of the accounting, get the sense of the taxation, how the taxation works in Canada, and take the maximum benefits of those. I'm going to occasionally they ask me from post-secondary institution to go to the post-secondary institution and talk about accounting. And I was in this class, grade 10, with these young kids. Not kids anymore, but ready to go to post-secondary, right? And one of the girl, she stand up and says, on the question why you like accounting, she said, I don't like accounting, but I want to have my own business. For that reason, I want to study accounting, I want to study a law, I want to study taxation, and I want to study management because I want to be successful in my business. And I'm sitting and thinking, wow, you're grade 10 and you already know exactly what you want and exactly how you're going to get it. Phenomenal. I can assure you that I've seen people way above that age who still don't know what they want and have no idea, if happen to know what they want, have no idea how to get it. But that was the interesting thing. So the next thing is, the next form of business is the partnership. What's interesting with the partnership? Interesting with the partnership is you need to have at least 2 people. You're not limited on the numbers of the people. You can, entire class here, we can form a partnership, but we need at least 2 people. One person cannot make partnership with himself. Doesn't matter how much you like yourself, you cannot open partnership with yourself. You need another person. Now, once you open the partnership, by the way, it will be discussed and explained more in the 1210, which is principal accounting second part. But just briefly to explain here, now the life of the organization of the partnership is limited to the partnership. Let's imagine this. Our class, how many people we have today? We have 29 people. 29 people we formed a partnership. When this partnership is going to stop existing? When one of us decide, I'm done. I cannot stand you guys. I'm out of this partnership. Then the partnership of the 29 people is over. Now the rest 28 people, if they want to form and continue with the partnership, they have to open the new partnership. Is this going to affect the business? Not necessarily. That's a different thing. business and the form of the business are two different things. So you have to understand this. Person who is liable? Well, obviously, partners are liable. To what extent? To everything. Same with the proprietorship. Since the owner is the individual is the owner, everybody can go if the company owes money or the partnership own money, if the proprietorship own money, they can go to the personal belonging to the individual who is the partner or who is the proprietor. Legal status, the partnership, the status lies with the partners. The business or the legal entity don't have a separate legal entity. Taxation, every partner is liable for the taxes and pay the taxes based on his own personal taxes. The partnership doesn't pay taxes, same like a proprietorship. And the last form of business, that's the corporation. And the corporation is, now the corporation can have shareholders. And that can be one shareholder, so it can be have millions of shareholders. What's the life of the corporation? That life doesn't expire with the if the one of the owners decide I'm out of this corporation, well, the corporation still stays. To what extent the shareholders are responsible? Only to the extent to their investment. Is the corporation a separate business entity? Yes, it is. It's a separate from the owners. So the shareholders has nothing to do with the corporation. And since it's a separate legal entity, corporation paid taxes on his own. And those are the three forms of businesses that I wanted to tell you. Now let's keep going with the concepts of the why do we need the accounting, and is there anything that we have to have in mind when we're preparing all the accounting information? Now at this point, I want to ask you, do you want a break? Otherwise it's useless. So let's put some fundamentals on this accounting. Let's talk about the principles and see what kind of concept and principles we're going to put in the accounting, again, for only one purpose, to make the information that we're collecting in our accounting systems useful for the decision makers, for the management, for the investors, for the creditors, and for the other authorities. Now, how to improve the usefulness of the information? For that reason, this general accounting accepted accounting policy come up, and they develop guidelines how we should do the accounting. Then International Financial Reporting Accounting Standard Body came and say, you know what, we are better. We're going to make a new standards, which standards will be for the entire continent. So if your country is part of the continent, you have to become a member of our association. When you become a member of our association, we have to apply our standards, which are standards are applied everywhere in the world. That's how users now of different investors from different countries can invest in the New York Stock Exchange in the company from everywhere in the world, knowing that they're applying the same standards, knowing that the information is comparable, true, free of mistakes. So in Canada, there we have this accounting standard board who's dealing with the standards for Canadian companies, and we have two type of main accounting companies, which are, one is the public company, the other one is the private company. Public company, usually those public accountable enterprises, they use international financial reporting standards. But for the small and medium size of companies, we're going to use accounting standard for the private enterprises. Both standards are prepared by CPA and are communicated to the people through the CPA handbook. Now let's see the framework. What's holding this accounting of information? First, we have to have objectives. What's our objective? First, you have to understand that this idea is you can apply it everywhere. Even in this course, before you start this course, before you even come to Douglas College, what's your objective? What do you want? Now, what the accounting standards want is our objective from the financial reports is to present and communicate useful information to the users. Then what we have to understand? First, we have to understand who the users are, and second, what means useful. What's going to make our information useful? First, we have to follow some qualitative characteristics. In order to be useful, the information has to be relevant, it has to be comparable, it has to be reliable, and it has to be understandable. And in order to be useful again, we're going to group this information in certain elements. One element will be assets, the other one will be the liability, third element will be equity, and we're going to have revenue, expenses, gain, losses. Once you put it in that form, that's going to make information useful. So once we do that, what will be the key assumptions that we're going to put in our information to make it again useful? First, we're going to have assumptions. Second, we're going to apply principles, and we're going to understand what the constraints are. Let's start with the characteristics. What's going to make information relevant? Information is relevant when it provides important information based on which you can help you to invest in the company or lend the money in the company. What's going to make information reliable? Well, in order the information to be useful, it has to be reliable. When the information is reliable, when it accurately represents what actually happened in the company, and there's no mistakes and no bias. What will be the bias? The bias will be the owner of the company happened to be the father of 4 kids. One of the kids was just recently accepted in the college. And the father feels that if the tuition fee for the college goes from the business, that's a reasonable thing. Well, but the investor might not feel that way. So we have to make sure that actually that tuition fee for his daughter doesn't go to the company expenses. Comparable. What means comparable? Comparable means when we have 2 different companies from the same industry, we can compare that information and can make a conclusion based on the information. Or when we look in the company year over year over year, they're not changing their principles. They're not changing the way how they treat the transactions. They're treating the same way, and we can compare 1 year with another year with another year with another year. Understandable. Now, that's something very interesting. We have to provide the information in a clear, concise way so the information is not misunderstood. But if that makes it understandable, that's a different question, because now it depends on the user's ability to read that information. If the user doesn't have the ability to read the information, whatever information we present, that may not be understandable for that user. Now, which are considerations in order to achieve that usefulness of the accounting information? You have to have some consideration. What's that? One is the economic entity consideration. Means that your daughter personal expenses and the college tuition, and you go for golfing with your buddies, those are not company expenses, period. But I want to be. Those so much expensive. If I have to pay from my pocket, I cannot deduct it for tax purposes, but if I put it in the company can put it as a business expenses, which will be advertising, because when I'm paying with my buddies, I actually kind of wearing a company t-shirt, which might fall under that gray area that actually promoting my company. Nah, doesn't work. Sorry. Right? That means don't mix one expense with another. So on the sole proprietorship means that ensure that we're accounting only for the business transactions, not the personal expenses. When we have a group of related corporation, every corporation recording the expenses uh, related to that corporation. We're not mixing one expenses from one corporation with revenue for the other corporation when reporting in the third corporation. That's not going to happen. And if the company is involved in the two line of businesses, we're not mixing those two line of businesses. If you're doing jams and jelly, that's come now. The jams and jelly comes from Despicable Me. That's the way it comes to my mind. I don't know why. But if you're doing a line of jams and jelly, and if you're doing lines of weapons, you're not mixing the expenses from the weapons to put it in the lines and jelly, uh, jams and jelly, and the opposite, right? You just keep it separate. So why? Because that's how it's going to make the information more useful. That's how you're going to find out which line of business is profitable, which one is not profitable, which one should I focus on, which one should I eliminate, for which one I need to apply for the loan, for which one I don't need to apply the loan, or can be self-sustained. That's how you're evaluating the success of the business. The other one consideration is going concern assumption. What's the going concern assumption? We assuming when preparing financial statements, we assuming that this company is going to keep going on the unforeseeable future or foreseeable future. What that means? That will be account for the resources the way it should be, rather than we'll be forced to accept the price, whatever the people give us. I remember I give the other group this example. I remember I told you 22 years is going to be soon. And I remember before I leave my country of origin, I have to sell my assets. Why? Because I cannot transfer over the Atlantic Ocean all the assets that I have. Even if I want to, I don't want. It's hard. So I have to sell them. But because I'm closing my life in one country and going with another country, I'm in undergoing concern. But not going concern means that I'm closing everything. My business is over. So for that reason, I'm getting whatever price is available on the market under new conditions. So I have to sell my car. Well, the normal market price of the car was I can't remember, but let's say $7,000-8,000. But because I want to sell it faster, what I have to do, I'm going to drop the price. Am I following the normal market? No, but I'm under different circumstances. In the normal circumstances, I'm going to keep the price. I'm going to wait for the right buyer, and he's going to buy it, and their life is good. I don't even have to sell my car. But because of those conditions, now I'm applying different concepts. Now, if the entity is not in going concern, so basically not continue going, then the accounting has to be done under the bankruptcy condition. The other assumptions that we have is that we have a stable monetary assumption, which means even though we have some level of inflation, the level of inflation is normal. What's the normal level of inflation? It's hard to me to be the judge on that definition, but for some country, 5-6% is not normal level of inflation. For some countries, that's okay. I don't know if you have experience to be in the level higher than that. I had that experience. That was very interesting experience. That was 1997 when I started my first accounting work in my life. I mean, actually, it wasn't, because I was working before that. I was helping one public accountants, if I have to be honest. So that would be more like a second or third job in accounting. But first official full-time job as an accountant, I started with local currency. Let's put it $14,000 a month, right? $14,000 a month. And I started in March, I believe was 24th, March 24th. By March 31st, my salary double was 28. By April 15, my salary double again. Now I'm getting 56. By April 30th, my salary was 102,000 a month. Within the next 2 months, I start getting 1 million. The funny part was, with 1 million, you cannot buy half of what you're able to buy with the 14,000. That was the hyperinflation. Don't ask me how because I was the treasurer, I was the person who give the salary for the other people. Don't ask me how I give them the salary. That was the funny part. Imagine this, we have to keep all the local currency. We have to, in order to protect from the inflation, we have to keep it in the US dollars. So when the payment date comes, we cannot pay the people US dollars. We have to pay them in the local currency. So what we're doing is I'm going to the bank, exchanging the US dollars to the local currency, and then the local currency and bring it to the office, put it in the envelopes, and give it to the people. Bank, ITM, and bank cards, forget about it. Everything's cash. 1997. Sorry, everything is cash in the envelope. That's how we give the salary to the people. So I'm going to the bank with 3 bodyguards. Why? Because on the way back from the bank, I'm going out with the 2 ginormous big bags, which I literally holding on my shoulders with money. That's how much money worth it on that time of the in the country. It was very interesting experience. It's kind of something that you can always talk about, and people can kind of laugh and experience that situation. But it was very, very interesting. I'm telling you, very interesting. And suddenly you're seeing that they start changing the size of the money. So instead of 2 ginormous bags like a Christmas bags that Santa Claus carrying, you're moving to the ginormous like a briefcases, and that briefcase becomes smaller and smaller and smaller because they start changing the size of the money and adding more zeros on the same time. It was interesting. The other one is the cost principles. Cost principle is, yes, we have to prepare useful and reliable information for the users. The question is, how much it's going to cost us? How much time we have to spend, how much time we have to invest, how much money we have to invest in order that information to be useful. The other thing is the cost principle. It's that's more like a cost benefit analysis, but the cost principle in this case will be the original cost. For all the transactions, we're going to use the original cost on which transaction actually happened. And that's how we call it reliable. And the cost benefits is here. The cost benefits is the value of the information versus the cost of the information. The next one is the materiality. Materiality is the mistake or level of mistake or amount of the mistake that's going to change our users' opinion about the information. So imagine this. You're going to the store. That's I'm gonna change the usual example that I'm giving to the students. I'm gonna give you another example. You're going to the store. Let's say you're going to, you can buy from Korean market H&M, very good stuff. So imagine you're going there and you're buying tuna for sushi. But on the label says this tuna was catch in close to Japan island, to the Japan coast, where the radiation level was 0.000003 milligram of uranium in the water. So the chances the fish to be toxic, it's not really there, but it might be. The question is, would you buy the fish? by knowing that. If that change your decision, that means that amount of the uranium in the tuna is material for you. If it's not, then you're gonna buy the fish. So again, the amount that changing your decision make you to change your decision to buy or not to buy, that's what we call material. Again, that will be the based on judgment. Who's gonna make the judgment? You's gonna make the judgment. Now let's see, once we know how to prepare useful information, what we're gonna put in that information. What's gonna put in the accounting record? Obviously, we have to group the accounting records in some kind of format. What we're gonna use for the format? For the format, we're gonna use this. We're gonna have assets, which assets will be everything that the company has possession on. We're gonna have a liabilities that the company owns to third party, and owner's capital that the company owns to the owner of the company. So let's think about logically. How many of you want to start their own business? Is there anyone who wants to start his own business? Any of you? At least one person. I'm looking for one single person who wants to start his own business. Yes, okay, 2 people. We have 2 people. Why do you want to start your own business? 4 people now. Why do you want to start your own business?
So I can work my own hours,
That's the only reason?
make more money as well.
To make more money. Let's focus on the very specific thing. Let's be rational here. Why people open their business? Because they want profit. Correct? Now,
Yeah.
what is profit? Profit is simple calculation between revenue minus expenses. Make sense? As long as the revenue is more than the expenses, you're going to generate profit. You already know that from your bank account. Why? Because your revenue probably is your employment income that's coming from somewhere. And the expenses, everything that you're paying for the grocery, for the gas, for the cell phone, for the courses, for this, that's all expenses. As long as what coming in is more than what you're paying, you're generating profit. In your terms, it's going to be saving. Now, let's put this one in the company. So the company has to generate revenue by selling something to the customers. Can I sell something for the customers if I don't have it? Yeah, you may say that, but most likely when the customer comes to your store, if you don't see that, let's say I'm the most stubborn customer that you're ever going to experience in your life. I'm just not saying anything. I'm just walking in your store, and if I don't see what I like, I'm just leaving. Did you find out what I'm looking for? No. Would I tell you what I'm looking for? No. If you don't have it in your store, I'm walking away. The question is, if I'm the one who generate revenue for you, so you can have a profit by selling me something more than what you bought it, how are you going to generate profit? When you don't even ask me what I'm looking for, right? So what comes first then? Well, that's first we need to have something in order to sell it. From where that thing's going to come? Well, we have to buy it. With what we're going to buy it? Well, that's another question, isn't it? So what we need first? We need assets. We literally need assets. Or we need economic resource. Which economic resource we can convert it into inventory, which inventory is going to be sold to the customer, and the customer is going to pay more than the cost of the inventory, and we're going to generate profit. Otherwise, there's no profit. So the question is, from where the assets going to come? Well, we have only 2 options because assets are equal to liability and the owner's equity. Technically we have only 2 options. Either owner has to invest from his own personal money and put the money in the company as a form of the assets, and then the company is going to owe the owner the whatever he put in the company, either we have to borrow from the bank. If I don't have any assets and you go to the bank and say, I want to borrow money, and the bank asks you, how much your profit? Oh, I haven't started my business yet. How much asset you have? Well, once you give me $100,000, I'm going to have $100,000 cash. What's the bank's going to say? Well, good luck, right? So what you need? You need economic resources, which are not liability. You need investments. So for that reason, we're going to the accounting equation, which accounting equation is very simple. Assets or economic resources coming from investors or creditors. If the assets come from the investor, the company owes money to the investors. If the assets come from the creditors, then the company owes assets to the creditors. In both ways, regardless from where the assets come from, the company owes money either to the creditors, either to the investors. That's why assets is always equal to liabilities plus owner's equity. If the owner doesn't invest in the company, there's no company. Company, there's no assets. If there's no assets, no cash. If there's no cash, no inventory. If there's no inventory, no sales. If there's no sales, no revenue. If there's no revenue, no profit. So what we need somebody to invest so we can, with the cash that he invested, to convert it to inventory, to find out the client, to sell the inventory to the client, make sure that we're selling more than the inventory cost. Then we're going to generate revenue minus the cost of the inventory. We're going to generate profit, which profit is going to come as a cash, as the asset, which asset we owe to the owner. And start again. And keep going that direction. So now let's see what the asset is. We already said asset is economic resource, which economic resource it's controlled by the entity or by the business. For what purpose? For generating benefits in the future, not now, in the future. Which are the examples of assets? Cash, accounts receivables. Accounts receivable is the money that the customer owe you because they purchased something which they haven't paid yet. Not receivables. Not receivable is more like you lending the money, somebody has to pay you back. Prepaid expenses, we're going to see what the prepaid expenses is next time. Land and building, obviously, we need those land and buildings to operate. And equipment, furniture, fixtures, that's more than we need those ones to operate. That's assets. Let's see the next category, liability. What's the liability? Liability simply is the money or the resources that we owe to the other people because we did something in the past. Most likely, those will be the creditors. Which are the example of the liability? That will be accounts payable or not payable or unearned revenue. What's unearned revenue? We're going to talk about more. Just now remember it's a category. Now we're going to the last section, which is equity. Well, if we put here, right here, let's insert something. What can I say? It doesn't let me to go anywhere, but let's work here on this one. I'm gonna just use this site and just to put something here to write something. If we put here the accounting equation, which is, again, the accounting equation is simply assets, which is equal to liability plus equity. Don't forget, this is a simple equation. What we can get from this equation? Well, I can express the equity. What will be equity equal to? Assets minus liability. So what equity in the company represents? The economic resources that the company have minus the liability that the company have. If there's anything left, that belongs to the owner. Well, let's think about your bank account. Is that true, actually? Let's think about your bank account. Do you know how much money you have in your bank account right now? Is there anyone who knows how much money you have or he or she has in your bank account? Now, the question is, are those your money? The money that you have in your bank account, are those your money?
Yes.
Yes, but how much of those are yours? Minus the money that you owe to the cell phone, to the electricity, to the, what would be that? Rent? Make sense? Yes, they own your money, but can you spend them? Can you just withdraw them from your bank account and say, I'm done, I'm free man? Can you do that? Not really. Why? Because you have to keep in mind, do I have to pay something? Do I have outstanding liabilities? So which amount of the bank account is yours? Whatever you have in your bank account minus everything that you have to pay to the other people. Because if you don't pay them, if you close your bank account, withdraw your money from your bank account and close your bank account and walk away. See what's going to happen. Is the people going to start calling you? Hey, where are my money? Why don't you pay your 15th of the month? Your telephone bill is due. It's first of the month. Your rent is due. It's this month of the month, this day of the month. I have to pay me this. So yes, you have money in your bank account. The question is, are they yours? Same thing happened with the company. The company is going to have economic resources. Are those economic resources belongs to the owner? Well, we have to see how much money the company has to pay for the creditors. Once we eliminate the creditors, whatever left, that's for the owners. Make sense? So for that reason, what's the owner's equity? Owner's equity is simple net assets. Which are the net assets? Economic resources minus liabilities. How are we going to get owner's equity? Well, first we're going to see how much the owners invested. Either cash, either assets. Second, we're going to see how much the owners withdraw. Then we're going to see how much revenue company generated, how much expenses the company incurred. And that's going to give us how much is the owner's equity. So, on the owner's equity, under the sole proprietorship, we're going to have owner's equity. Every time when the owner wants to take the money from the company, he can simply withdraw the money. Partnership. In the partnership, we're going to have every partner, he's going to have his own account, his own equity. When the partner wants money, he can withdraw from his account. How about corporation? Well, in the corporation, we're going to have as shareholders equity. Can the shareholders go into the company and say, I want $100, give it to me? Can the shareholder do that? No. Some of you may have shares of Apple or from Amazon, whatever you have a shares. Having one share doesn't give you any rights. You cannot go to the Amazon and say, hey, give me $10 because I'm short on cash today. They're gonna say, oh, who are you? I'm investor. I'm your investor. I'm a shareholder. I own equity of your company. Good for you. Let's pay our liability first, and let's see if there's something left that may be yours. So, for that reason, what we have to remember is the owner's equity increasing with any investment that the owners make into the business, and any revenue that the company generates. And the owner's equity is going to decrease with any withdrawal from the business and any expenses that business incur to generate revenue. So here, then if I cannot withdraw the money, how can I get the money from the corporation? Well, that's called dividend. Only and only when the company declared dividend, then you can take out of the company. Until then, wait. So revenue, what's the revenue? Revenue is earned by either delivering goods, either delivering services. You can see the restaurant. When you go to the restaurant, you're asking for the food, they're delivering services, and they give you goods in the form of the food. The service is preparing the food, and then you paying them. And they're hoping that the money that you're going to give them is more than the cost. So that will be fee earned, sales, merchandising, rent earned, interest earned. Then we're going to have this category which called expenses. Now the expenses will be anything that we're paying in order to earn that revenue. Remember, expenses are related to earning the revenue. Again, with the restaurant, expenses of the restaurant business will be anything related with to serve the food to the client. Again, my daughter expenses for her trip to Hawaii, it's not expense for the company because it doesn't help me to earn money in my restaurant. So the examples will be rent, salary, wages, utilities, supplies, amortization, depreciation, anything like that. And then we're going to extend this, the first chart that we make. So we're going to have assets, we're going to have liabilities, we're going to have owner's equity. But in the owner's equity, we're going to put this. First, owner's equity going to increase with the investment that owners make. It's going to decrease anytime when the owners take money from the company or corporation declare dividend, and it's going to increase when the revenue is more than the expenses. But if the expenses are more than the revenue, then the owner's equity is going to decrease. How are we going to do this? Well, we're going to do it through the transactions. So what we're going to do, every time when something happens in the company related to the business, we're going to treat it as a transaction. We're going to record it in the proper way, in the proper place, in the proper account. And at the end of the period, we're going to see how much is the revenue, how much is the expenses. That's going to give us the income, how much is the owner's equity, which will be the beginning balance plus whatever owners invested, minus the withdrawals, plus the net income or minus the net loss. And then we're going to see what's company have available in form of assets, liability, equity. That's what we're going to do now. How are we going to do it? First, we have 10 minutes to do it. Most likely, we're going to extend it to 12 or 13. Second thing that I want you to do is I want you to follow me here. I want you to go to Blackboard, which Blackboard is right here. I'm going to show you in a second. Let me grab your Zoom. I want you to go to Blackboard. I want you to go to course content. Once the course content open, I want you to go to chapter 1. Once you go to the chapter 1, I want you to scroll down and go to the cases for practice. I want you to click on this case for practice, and you're gonna see 1, 2, 3 questions, 4 questions, and 1 answer. I want you to click on Q5 transactions. That's Excel spreadsheet. I want you to click on that one, and you're gonna see some file. Now I want you to download that file. Here on the very right side, you're gonna see this arrow with the box in the box. That's download. download that file on your computer device. If you have computer device, if you have a laptop on the laptop, if you have a cell phone, you're gonna watch the recording later and you're gonna do it later by yourself. Save it on your computer. And once you save it, you can open it in your screen. Once you open it in your screen, you're gonna see something like this. Let me see if you can see my screen. If you cannot, I'm gonna make a new sharing with the screen. No, you don't see my screen. So let me make a new sharing with you. And on the new sharing, you're gonna see the Excel spreadsheet, which looks like this. Now you can see my screen, correct? And now what we're gonna do, we're gonna do accounting. We're gonna put these transactions into the accounting, into different accounts. We're gonna prepare the reports and we're gonna see, is this company generating profit or loss? How much is the owner's equity? And how much is the assets, liability, and owner's equity? So let's start with the first. First transaction that happened. This company is brand new company. They just open it. And this is the computer service company. First month of operations. And the first thing that happened is the stockholder or the shareholder or the owner of the company invested $36,800 in the business, and the company gave him common stocks. So what's important here? First, the most important thing is assets always to be equal to liability and shareholders' equity. What that means is every time when you put on one side of the equation here, you have to put the same thing on the next side of the equation. So basically here we're going to have this. So always those have to be equal to each other. Assets equal to liability. As long as you keep this one, we're perfect. Second, this is our check. If the assets is not equal to the liability, here we're going to have amount. So our objective is to keep our check zero, the way it is. And we have options for different assets accounts. Only one option for the liability account, and different options for the shareholders' equity. What is the shareholders' equity? We have to understand what the owner invested plus the revenue minus expenses and minus dividend. So every time when the owner invests money, that's going to increase the shareholders' equity. Every time when the company generating revenue, that's going to increase owner's equity. Every time when the company spent money to generate this revenue or for the operation, that will be decreasing the owner's equity. And every time when the owners deduct dividend, that's going to be decreased. We can put that one in the red. That's going to decrease the owner's equity. And once we know that, now we can start. First transaction, owners again invested $36,800 cash in the business and he received common stock. So what's happened here? What the company get? Company get $36,800 cash. That's what the company get. What the company give? This is what we get. Economic resources. That's from where the economic resources came from. Did we borrow money? No. What happened? The shareholder invested and we gave him common stock. Well, let's give him the common stock. How much are we going to give him? Exactly the same amount. And 800. Boom. Now, assets, it's equal to liability 0. Equity 36,800. Our check is 0. Life is beautiful. We can start focusing on the second transaction. Second transaction. What's happened in the second transaction? Well, company purchase equipment for the office, computers for the office, which is equipment, for 27,600 on account. Now the question is, did the company pay cash when they get the computers? The answer is no, they didn't. Do they have to pay cash? The answer is yes, they have to. Why they didn't pay cash? Because the company put them that money that they own in their account. So same thing that happened when you go to the bar. First thing that the bartender asks you is, are you paying right away or should I put it on your tab? What means tab? On your account. So every time when you order, you're not paying right away, he put it on your tab. You're adding to your account, you're adding to your account, you're adding to your account. And at the end of the night, you say, I want to close my tab. I want to close my account. What's the balance? And he tells you the balance, and you're paying one lump sum at that point, and then life is beautiful. So let's apply the same approach here. What the company get? Company get 27,600 computers, worth of computers. But they didn't pay for it. Do they have to pay later? Yes, they do. What will be that for the company? That will be accounts payable. Why? Because it's on account. Every time when you see on account, that will be, if we have to pay, that will be accounts payable. If we selling, but the customer doesn't pay it, customer can also go on account, that will be accounts receivable. So as you can see, once I add asset, here the check starts with balance. So I have to put something on the liability side. So my equipment goes up, but my liability also goes up with how much? $27,600. So now in balance. My equation is in balance. Everything is good. Now let's do the next one. Next one is in May. The company pay cash $3,680 for rent of the storage space. Do we need the storage space to do our business? Yes, we do. Is that business expense? Yes, it is. Why we open the business? To generate revenue. Is this related to our revenue? Yes, it is. So let's see what's happened. First, we paid cash. So that means our cash gonna go down minus $3,680. What else gonna go down? Equity is gonna go down. Why? Because the expense is going up. How much equity is gonna go down? With exactly the same amount of the cash. So we're gonna have expense of minus $3,680 for the rent. And we pay the rent expense. Now let's see number 4. Now we opened the company to provide computer services. Well, finally we provide the services, but the client didn't pay. And we have to put whatever we sold to the client on his account. Well, let's do it. First, let's do the revenue. We're generating revenue, $17,480 revenue. But the customer didn't pay. So he has to pay. So we have to open the account for the customer. And we're going to say, now we have accounts receivables because he's going to pay us later. For how much? $70,480. Now let's see number 5. What's happening in number 5? That's happened the same thing. We perform computer services, but now the customer pays us cash. So our revenue is still gonna go up with $4,600 because we're performing revenue, we're performing services, but in this case, the customer actually pays us cash. So we're gonna get the cash right away. Once you see cash, just get it. Once you smell the cash, get it. Next one. The company, since we have this warehouse, since we have the storage space, now we have to pay for the energy that we use for May. Sadly, but we have to pay for the energy and we pay cash. So what's going to happen with our cash? Our cash is going to go down. With how much? With 7,360. So, okay, our cash going down, that's fine. Let's move those one here. And but what's that energy for us? Well, do we need energy to do our business? Yes, we do. Can we do our business without having the warehouse, which warehouse is without energy? No, we can't. So what's going to happen? That will be expense for us. And for how much? For the 7,360. How this expense gonna affect our shareholders' equity? Well, it's gonna bring it down. Sadly, but it's gonna bring it down. So what I'm gonna do here, I'm gonna format those cells. I'm gonna bring it here so that everybody can be formatted. So I don't have to do it again. Next transaction is number 7. Is now the company paid for the computers that they purchased in number 2. So in number 2, we purchased those computers for 20, which worth 27,600. We didn't pay, but now we pay. So what's going to happen now? If we're paying, our cash is going to go down. With how much? With exactly the same amount. So our cash going down with 27,600. But since we pay them, we don't have to pay them again. So our accounts payable also going to go down with exactly the same amount that we paid. And accounts payable is gone. Next thing, number 8. What's happened in number 8? In number 8, we purchase advertising expense for the month of May on account. Now we get the expense. The people deliver the services. Our services is 196. So the services is negative 1196, which is going to reduce our equity. But we didn't pay. Well, that's going to increase our accounts payable with exactly the same amount, 1196. So we imbalance because we have liability goes up, owner's equity goes down, and the balance is 0. The last transaction is we receive from the contract. Remember, these people that purchasing on account 70,480, they paid us $11,040 cash. Let's get the cash first right away. $11,040, $11,040. We get the cash. Well, since we received the money, we have to reduce their account with same amount, 11,040. That will be $040. So once we do that, what's going to happen is we're still going to be in balance. We're still going to be in balance. So why this one doesn't show me in the negative? Let's go this way. There we go. We're still in balance, but this transaction affect the cash going up and accounts receivables going down. Once we do this, what we can do is we can calculate our totals. Why do we need the totals? Well, basically because we want to see in the month of May what happened in this company. Well, company generating revenue, correct? We can see it, but also incur expenses. So if we have to prepare the income statement, we're going to have the revenue, we're going to have expenses, and we're going to have the profit. And the profit, we already know that profit's gonna be revenue minus expenses. So once we get the revenue minus the expenses, this company generated for the month of May, they generating profit $9,844, which profit belongs to the shareholders. So let's see now what's happened with the shareholder equity. Now let's find out how much the company owes to the shareholder only. That will be statement of equity. I'm going to put it like this, or statement of equity. So what we're going to have? Beginning balance of the equity, which was 0. First month of operation, there was no balance. Then the investor invested. Then we're going to see investment. We're going to add that investment, which investment he invested $36,800. Then we're going to add revenue or profit, also called net income. Then we're going to deduct dividend, which dividend in our case is 0 because the company didn't declare anything, didn't get anything to the owner. And then we're going to see what's our ending balance here. Ending balance of the equity. And that ending balance is going to be simply the beginning balance plus investment plus net income in this case minus dividend. And we're going to get our equity. Then we're going to ask ourselves, what this company has? Well, the company is going to have economic resources. What will be the economic resources? Assets. And we're going to see how much cash we're going to have, how much accounts receivable is going to have, and how much equity you're going to have. Then the company is going to have liability. And we already know how much is the equity of the company. So what we can prepare balance sheet. And for the balance sheet, we're going to have our assets, which assets going to be cash, accounts receivables, and equipment. And our total assets, we need the total assets. So let's see, cash is equal to 13,800. Accounts receivables, 6,400, they still have to pay us. Remember, they have to pay 7,400. They pay us only 1140. They still have to pay $6,440. And the equipment is 27,600. And that's give us total assets. Now, what we have to do is to see if the total assets is going to be equal to the liability and owner's equity. And if we get it right, they should be equal to. This one is our liability, and the owner's equity already calculated, 46,640. And when we get the total liability plus equity, it should be equal to the total assets. Let's see if that's actually true. It is true. So basically, we prepare our first financial statements for the company, and we prepare the income statement. Statement of the equity and the balance sheet for this company for the month of May. Congratulations, you are accountants.
Sir, I'm sorry, where the liability came from?
Liability came from From our liability, accounts payable, right? So first when we purchased the computers, we didn't pay. Then we pay for the computers. But after that, we have these advertising expenses, which we didn't pay. And that's why our liability came here for the advertising expenses. So once we get the liability, we're going to get that amount, which will be our liability.
Okay, sure. Thanks.
You're welcome. I know I'm keeping you longer than I have to, but thank you for staying. I wanted we to finish this today, so next time we can have more things to talk about it. Thank you for today. Let me know first questions.
No, sir, thank you.